Gruber, and welcome to the Multifamily and More Expert Series, where we dive deep into a specific topic with our expert guest in the area of either multifamily, could be mindset, or anywhere in between, including screaming kids in the background. My guest today is none other than the one and only Benoit Malige, my business partner. Benoit is a multifamily investor. Benoit is a turnkey investor. He is a developer at this point. He's done it all. And I'm happy to have him here on our show today. Ben, how's it going, buddy?
Good. Thank you for having me on the show.
Yes, no problem, Ben. That's not a problem. So Ben, if you can't tell, is sort of the back of house guy, right? Like I'm more the out in front guy. Ben deals with the nitty gritty stuff. And I guess this show is really kind of a two guest show, right? We're gonna kind of double team the topic today between you and I, right?
Yep.
Beautiful. So our topic is really related to a question we get quite a bit, which is, hey, you guys are entering the syndication market. What does your model look like? How do you present your model to investors? What's the gist of your plan? So we're going to go through our investor presentation for all of you. We'll take it. We won't go bullet by bullet. We won't present it like you're the investor, but we'll at least let you know and let you see what we're doing, what our syndication looks like, because it's a little bit different than the traditional, but also how we present that syndication model to investors to acquire capital. So that's the plan, unless Ben has any other thoughts that we need to do.
Sounds good.
You like it?
Right into it.
Let's get right into it. Ben's a man of action, everyone. Man of action. So, all right, we're gonna roll you through this. So our presentation is, we put it together in PowerPoint. Ben did a great job with it. And we start out with a listing of who our partners are. So you see Ben, you see me, suited up nicely. One's smiling, one's not. Me, not Ben. And then in the middle, there's a new name to this formula, and that's Thibaut. So Thibaut and Ben are partnered up on a turnkey company. Thibaut and Ben are both French nationals. They're born in France. They live in the U.S. now, obviously. But Thibaut is a capital raising specialist. And the way our fund is structured through the SEC is that we are able to take on international capital. And Thibaut has a lot of ties to folks in other countries that can invest in our fund. So he's a third partner in the deal, or in the fund, I should say, and somebody that we want to make sure, all of us, we want to make sure are presented well to investors, even though you're not smiling, Ben. I don't know why.
I do my best, Jamie.
That's not your best. Smiling isn't your best?
No.
No. All right. If you say so. All right, so Ben, why don't you take people through how we present our process? So before you do, we kind of outline this as three separate things: our process, our criteria, and our terms. So those are the three areas that we lay out for investors. Ben, why don't you talk about what our process is?
Yeah, I mean, it's pretty straightforward, right? So we're looking for deals. We're going to go into the specifics of what kind of deals we look for, but we go into the acquisition phase, and then raise capital with the help of Thibaut, you and myself, and acquire the asset, implement the value add. That's a very important aspect of our process as well. Stabilize the asset, and then refinance, which is probably the main difference between what we do and traditional syndication. We're probably going to go through this in a little more detail in just a bit.
Yeah, no, agreed. That's the big difference. Most syndications, they dispose of the asset at the end, and we're not doing that in our process. So, Ben, you want to touch on our criteria?
Sure. We only look for apartment buildings. Like I said earlier, these assets need to have some sort of value add component in it. It's very important for the refinancing aspect of this. We have two target markets, which are Southeast Michigan and we put Ohio, but it's mostly Cleveland. And then we look for anything that will have a value of $1 million and up. Also very important for the refinancing portion. So that typically equates to 20 units or more. And then we need something that will generate, once stabilized, a minimum of 10% cap rate or cash on cash, just return.
The return, right, at stabilization. We're looking for a 10% return. So that's what we lay out for our investors. So when we get into our terms, what we offer to our investors in this model is an 8% fixed annual return. You can call that almost like an interest rate, because we are structuring this initially more as debt than we are as equity up front. All right. Once we refi, we're giving them 10% of the equity in the property in perpetuity. So whatever that investor pool looks like collectively, they get 10% of the property in perpetuity. They also get 10% of the refinance proceeds. So very simply, if we buy it $1 million and we refi at $1.5 million, that $500,000, 10% of that goes to the investors at that time of refi. And here's the biggie: we return their capital. Our target is to return their capital that they invest with us within 2 years. And we'll go through the differences between our model and the traditional model in a moment. But if you're at all familiar with syndication, that is a much shorter term. Puts a lot on us, but it's a much shorter term than most syndication models that are out there. Ben, do you have anything to add on this, or does that pretty much sum it up?
No, that sums it up.
Beautiful. So we're going to talk a little bit about kind of the difference here. This is what we talk about with our investors anyway, or potential investors. How we present it to them is, hey, so our investors, you have to imagine, are saying, okay, I know what syndication is. If they're sophisticated or accredited. I put my money in, I'm part of a 70% pool of equity in the property. My money comes back to me in a certain amount of time. It takes a while, 7-8 years, something like that. And I get a preferred return all the way through that, right? That's kind of the typical model. So what we do is we try to break this down so folks can understand the difference. And look, investing is good no matter what you do, no matter what syndication model, but we feel like we've got a bit of an edge or a competitive advantage with ours for the investor, as well as for our core model of wanting to retain the asset after the term is up, or once we go to refi instead of sell the property. So I'll roll through these things. I don't want to get too in depth, but I will have Ben add some color as needed here. So, as I said, the term of investment in traditional syndication is usually 5 to 10 years. That's how much your capital is tied up, or how much time your capital is tied up. In our model, we're looking at, up to 2 years. So a much shorter time to get your capital back. From a taxation perspective, when you're taxed on a traditional syndication because you're getting a return, like a dividend, you're taxed at ordinary income. Whereas with ours, because it's more of an interest payment, you're taxed, it's sort of deferred or taxed. We'll talk about that in a second. Ben's much better at explaining this part than I am. We don't take fees in our model. So we're not doing any acquisition fees, which are more than necessary, I know, in most syndications. But in our model, we're saying to our investors, hey, the money goes to you. We're not loading this down with fees. We're not adding additional investor capital into the entire pot here so that we can pay us fees. Our goal is to take the income at the end, after we've performed and repositioned the property. All right. From an IRR perspective, on the traditional side, it includes sale in the IRR. Ours does not. This is the big difference, I think, and why people are like, well, all right, well, why wouldn't everybody do it this way? Well, a lot of syndication models are looking for highly stabilized assets that they do some improvement to, they add some value to, but they need time. They need 7-8 years for them to return all of their investor capital back. We're really syndicating in a model where we're looking at high upside proven assets. So maybe your low B seed class assets that have a lot of potential upside, your mom and pops. All right. And from a recession standpoint, I think this is a fair point that we like to make is, hey, if you're buying at retail, high-end property, in a recession, you're at risk more so than if you're buying at almost a wholesale price with upside. So we think we're protected a little bit more, and we feel like we're protecting our investor capital a little bit more with our model than what the traditional syndication model is. So Ben, I want to get into the technical part for our listeners around taxation specifically. So can you give a little bit of detail on what our difference is in our tax model?
Yeah, so we see deferred / tax-free / ordinary income. So as you were mentioning just before, Jamie, the deferred taxation on the front end, which is basically the 1 to 2 years before we refinance, since it's more of a debt reimbursement to the investors. It's not taxed as ordinary income. So the only taxes that investors would pay on that would be if one day we get to sell the property. So that you're basically, deferring the taxes on that end. Once we do get to the refinancing portion, if we have, the goal for us is obviously to have this little delta and making money in the process. So cash out refinancing. This is tax-free, so there's no tax on that either. And then at that point, once it's stabilized and refinanced, then we get into ordinary income tax for, because the money is going to come from the cash flow, basically.
Makes sense. All right. IRR, you want to dive into that a little bit?
I mean, I think you mentioned what needed to be said. Since we don't sell the asset, we don't plan on selling the asset. We obviously can't put that into our calculations for returns to the investors. So, if we show a 34% total return, it's not including the sale. Yeah.
That's it.
That's it.
That's it. Got it. All right. You're going to hear chaos potentially in the background of my home. I have children and dogs going nuts. But we'll get there. We'll get there. We'll get through all this stuff. So
I think if you could go back to that slide really quickly, I think just, the reason why we're able to do this differently is because of the willingness to find those more difficult deals that require a lot more work than the ones acquired by traditional syndicators, right? This allows us to buy these properties at huge discount. This allows us to be able to get investors in and out in a shorter period of time, and then refinance and not sell these properties. So it's a completely different model, but from the start, because we're willing to put in the work for these assets that are in difficulty to begin with. Beautiful.
Well said. Well said. So we're going to go through a specific example here, a couple slides where we talk about what this model looks like. So this is an actual property that's been analyzed. So on the left is the I guess where the property was at the time that we're analyzing it. And on the right is what it would look like after it's been repositioned. So on the left, you can see that the income 316, you see all the expenses, and we get down to about an NOI of 135,000. On the right, you can see we've increased the rent a little bit. We've decreased the vacancy. We've optimized expenses, I'll say. We gave ourselves a little bit more on the tax side, a little bit more of a reasonable management fee, not $6,000, but $25,000 on this 48 unit. All of that equates to a net operating income of about $115,000 more. So that's the potential upside on this particular property. When we get into what this property looks like from an acquisition and refi perspective, you can see the purchase at 1.47. We budgeted a $430,000 budget for renovation, and $150,000 in acquisition costs. This isn't fees, but this is closing, due diligence, all of that, right? So that's the $150,000. That totals to $2.05 million. The bank debt would be 1.52, which is essentially 80% of the renovation and acquisition. And then we would need investor capital for that difference. That $530,000 in investor capital makes up the difference between the loan and the $2.05 million that we need to acquire this property. All right, so that's where our investors would put their capital in, $530,000. Once we've stabilized it, you can see the NOI, the ARV goes up to 3.5 million. Our debt is now 2.8 million. That's 80% of that. At a 5% interest rate and a 30-year amortization. And the key here is non-recourse. While we're eligible for non-recourse up front, we're not going to take non-recourse debt because we need, or we're not going to even be able to get non-recourse debt because we need a local bank who can see our projections and everything else like that to acquire. But once we're stabilized, we can refi into non-recourse. So we pay off that 2.05 million on the left, that total for the entire purchase acquisition, and leaves loan proceeds of $818,000 and cash flow of $66,000 a year. So that's the power of our model when we find these properties that have the upside that they do and what we can do potentially on the back end. Ben, I know I ran through that fairly quickly, but what points do you think you want to make here, if any?
I think that was great. You did mention the non-recourse versus recourse, and once again, it comes back to the type of properties that we're targeting. These are properties that are, you know, not performing well or not performing at all, and that do not allow for, let's say, traditional non-recourse financing. So we get in there and we have to find local banks that know the market, and we're willing to, you know, take on the risk of having basically liability on that loan, because we know we come in with a specific plan to stabilize the asset within 24 months, and then get non-recourse financing once everything's back on track.
Yeah, important for us to outline that for investors. So we do. We put it in this example, and hopefully for most, and so far it has. I think the folks that we have gone over this with, have committed capital based on our model. So we're pretty happy with that. So what does this do for our investors? So I mentioned they invest $530,000. I'm putting it for 12 months just to give you a sense of what a year's worth of return would look like. Okay. So preferred return, as we mentioned, kind of like interest at 8% yields $42,400. So that's 0.1. They give us 530. The preferred return alone is going to yield $42,400 in income. The equity at the time of refi, all right, is going to be 10%. So the refinance loan proceeds, if you remember on the prior slide, it said 818,000. Well, 10% of that goes to our investors. That's $81,800 after we refi. And then 10% of that $66,000 in cash flow goes to our investors. That's $6,600 per year, and that's forever. That's perpetual. And then finally, the equity in the project, the difference between the loan and the help me out here, Ben. The difference between the loan and the
difference between the new value and the new value of the asset and what we own it with the loan.
There you go. Thank you, Ben. I got my mind.
Kind of that 20%.
Right. That's $71,700 at the time of refi.
That's time of refi, and it goes up every month as tenants make rent payments.
Right. So really, really great return. So when you add it all up, the 42.4 in the preferred return, the 81.8 from the 10% of the refinance proceeds, the 71.7, which is 10% of the increased equity, not including the 6,600 a year in cash flow. It's 195,900 on a $530,000 investment, or 37% return on investment. So it's potentially a very, very powerful model. All right. So our return promise to them is 8% preferred return or interest, and then 10% of the equity and 10% of the refinance proceeds. So that 37% ROI could go up or down, but the point is we're just trying to illustrate that all of this together equals a pretty healthy return on whatever the investment is. And the other distinction here is, just to be clear, that $530,000 in investment, all of these numbers, if one person gave us $530,000, would all go to one person. If it were two people that gave us the 530, we'd split all these numbers, half would go to one, half would go to the other, and so on. But yeah, pretty good deal.
Yeah, the quick note on the 6,600 per year in cash flow. The reason we don't include that in the total return is simply because we can't, because it's an infinite return. Once the property is refied, then the investor gets his money back, so he makes 6,600 a year with no money in. So if we just can't include that in there, so it's basically a bonus after that.
Right. So for our investors, the goal here is, again, we're returning capital pretty quickly to them within a year or two, so that they hopefully with happiness over our performance, will reinvest that capital frequently. And every time they do that, they're getting 10% of an asset every time. So over, a 10, 12 year period, you could potentially reinvest 5 to 10 times, and, end up with, 10% of 10 different properties. So, it's a pretty cool model. We like it. It's not unique. There's other companies doing this, but for us, we feel like it works best with our value of buy and hold. While
we feel like it's a fair model. It's really a win-win for everyone. Yeah.
Beautiful. So Ben, at this point, usually says in French, merci beaucoup. Oh, the beaucoup. I forgot the beaucoup part.
Yeah.
But yeah, so that's essentially our model. That's what we do. That's how we operate, how we plan to operate. Ben, any closing thoughts before we end this expert series?
No, I hope this was simple enough. We do, make a lot of efforts to make things simple, and this is just how we try to invest as well. Keep it simple, make things, to take complicated things and make them simple so people can understand, so we can understand, so Jamie can understand.
Mostly so I can understand.
Yeah.
So no, I agree. I hope for everybody they get some value out of this. It's a model you can use as well. Obviously, it's a format you can use. But yeah, if anybody has any questions, anything they want to talk through, you know where to reach me, you know where to reach Ben. Jump on to cfassetgroup.com. You can get all of our info. The Multifamily and More brand is on there as well. You can register for any group that is of interest to you. I think we're at 9 now.
Yep.
Something like that. So yeah, appreciate everyone's time. Ben, thank you for taking some time this morning.
Thank you for having me on the Jamie Gruber show. I didn't want to make that joke, but I had to.
Yeah.
Thank you. I appreciate it.
Goodbye, everyone. Thank you, Ben.